Welcome to our comprehensive guide on asset allocation. I'm your host, and today we're diving deep into how to strategically manage your investments. Asset allocation refers to the strategy of distributing your investments across various asset categories. These typically include stocks, bonds, real estate, and cash. The goal is to balance risk and reward according to your financial goals, risk tolerance, and investment horizon. Why should you care about asset allocation? Proper asset allocation can help you manage risk more effectively by diversifying your portfolio. Imagine you have a portfolio of $100,000, and you decide to allocate 60% to stocks, 30% to bonds, and 10% to cash. Over a year, stocks might generate a return of 10%, bonds 5%, and cash 1%. Now, let's calculate the overall return of your portfolio. Asset allocation is not static. It should evolve as your financial situation, goals, and market conditions change. Rebalancing is essential to maintain your desired asset allocation. Here's a scenario-based question for you. Imagine your stocks have significantly outperformed and now make up 70% of your portfolio. What should you do? The answer is you should consider rebalancing your portfolio to bring it back to your original allocation strategy. This helps manage risk and prevent overexposure to any single asset class. Historically, different asset classes have shown different patterns of returns. For example, from 2000 to 2020, stocks generally provided higher returns compared to bonds, but with greater volatility. Now, let's categorize asset allocation strategies into three types: conservative, balanced, and aggressive. In a conservative strategy, a larger proportion of the portfolio is allocated to bonds and cash, minimizing risk. For instance, 20% stocks, 70% bonds, and 10% cash could be a conservative allocation. A balanced strategy involves a more equal distribution among stocks, bonds, and cash, such as 50% stocks, 40% bonds, and 10% cash. An aggressive strategy typically involves a higher allocation to stocks to maximize potential returns. For example, 80% stocks, 15% bonds, and 5% cash. Let's take another interactive question. If you're in your 20s and investing for retirement, which asset allocation strategy might be more suitable for you? Given the long investment horizon, an aggressive strategy could be more suitable to maximize returns over time. It's essential to periodically review your asset allocation. Let's look at how rebalancing works. Suppose initially, you allocated 60% to stocks and 40% to bonds. After a year, stocks appreciate and now comprise 70% of your portfolio. Rebalancing brings these back to the initial 60 to 40 ratio. To get a clear understanding, let's visualize the process of rebalancing. After 1 year, the stocks perform well and now make up 70% of the portfolio, requiring rebalancing. After rebalancing, you'll adjust back to your strategic allocation of 60% in stocks and 40% in bonds. Remember, rebalancing is crucial to maintain your desired risk level and achieve long-term financial goals. To summarize, asset allocation is a dynamic strategy that balances risk and reward according to your unique financial situation, goals, and risk tolerance. By understanding and implementing asset allocation, you can make your investments work more effectively towards achieving your financial goals. Thank you for joining us today.